Or did the weekly expectation kind of make sense? I know I wasn't commentating Wednesday through Friday, so did the week close make sense to everyone? Anyone have any questions about that delivery kind of post CPI Wednesday onwards? We had a really nice TGIF close on the week. I don't know if you guys can't see my stream, but like this was a really nice expectation going into Thursday Friday. Kind of just waiting for this weekly range to be capped off right in here. And then once we saw some sort of SMT, which we got right here with the Dow, this capped off the weekly range, and then trading kind of short back into this range, right? So we have open, low, high, close, and then this is 20 to 30% in here. So that's kind of the expectation that we could use moving into Thursday, Friday, was just playing that retracement back into the close. And what's really cool is that on Friday, I believe, we ended right. We're very sensitive to that TGIF range, which is something I've always personally studied, but it's the sensitivity to this area right here between 20 and 30. So in the afternoon, we formed this large SMT with the Dow, I believe. I think it's in my daily. Yeah, it's in my daily recap. I have this. But once we form that, on the 5 minute here, this entry right here would have been so nice, this order block, because there's a tiny imbalance in here, a really small one. It's still an imbalance. It's just very small. We have market structure shift, imbalance, order block, and then all you do is trade from here back up in to like either this 20% or even just halfway of this range. Like it's really nice because your stop loss is very, I mean, you can go for a 2R trade. Yeah, this is a really nice Friday. This is like the ideal way to play the TGIF setup, is to play the close of the weekly candle, right? Because the daily candle here, hi Mango, the daily candle has an open, high, low, close, and then this weekly candle, right, is forming this part right here, which is that high close, and it's really gonna form it from the hours of 1:30 to 4 p.m., right? So here's where you want to be looking. This is the close of the weekly candle. So here's where you want to look for any deviation outside of this range on a classic buy week. What you want to do is just trade back into it for the candle to close. So seeing like a large liquidity sweep and all of this low resistance chop into that is a really nice potential long. That was like the one trade on Friday I wish I was like feeling good enough to take, but I completely slept through the market there. Like I was just, I was not feeling well. Let's get rid of all that. Okay. You were in the accumulation phase of sickies, and now it's manipulating to the other end. Yep. As market, it's efficient, right? The sickness, illness is so efficient in this case. It goes from one member of my family to another member to me. Can we talk about how to draw SMT? Is it always the same time frame or a general area? Great question. I like to look for SMTs either in one of two areas. A time at base SMT, meaning during a session, right? Like New York Open, London Open, or in this case, that 2 p.m., right? That 2 p.m. candle, i.e. the closing of the day. Now that's a little bit more vague than just saying you want to look for SMTs inside of key levels of interest. So for example, before FOMC, like this, or not FOMC rather, CPI, we know there's likely to be a highly volatile distribution phase. So what we want to look for and study is any SMTs inside of this array, right? They're going to matter more because of time and price, because the market is likely to expand away from this high volatility driver. And obviously we're in bullish market structure based on this Tuesday reversal profile, in which we also had this lower time frame SMT down here. So once we see that, right, we want to now monitor. Let me just save and reload this so we can look at all three. For SMTs, we want to be monitoring specifically formations that form inside of this area of interest. And as you can see, we get a really nice divergence with the ES inside of our PD array of interest. And then we also get a lower time frame SMT, right, in that same area right there. So you actually get two SMTs that form. Both of these SMTs inside of that area with time are like very telling. So that's usually how I use SMT, is I try and pair it with like a time-based confluence, a news event or a PD array of interest.
That was a nice SMT at that spot.
Yeah, sequential SMT, right? It was 2 sessions, or higher time frame and lower time frame.
Well, yeah, like ES didn't go into the BISI, and then it took out the low that, so forth.
Yeah, it was beautiful. Likewise, like when anytime you want to look for right any sort of change in state of market delivery, like in this reversal here, like I have it all marked down under daily recap. So this is a good place to study Chitra for like that question specifically. But if you look at where the SMTs happen, right? This SMT happens when we form our like weekly profile, which is going to be a classic buy week, right? So now we expect every phase of reaccumulation and reexpansion to offer SMT as well. So here's on Wednesday, we offer SMT as well. All right, this is sequential SMT that we were talking about. Then on Thursday, right, when we cap off the weekly range, you'll notice we offer SMT as well with YM right in between these two highs. And then on Friday, at the lows, we offer SMT. So every time price delivery changes, right, from a form of accumulation, distribution, or manipulation in the market, we'll notice SMTs. And if you actually zoom in on lower time frames, you'll also notice SMTs when you're entering the market, because this reversal into accumulation, into expansion, right, this retracement lower is a lower time frame sell model, which will then result in an SMT at our entry. Likewise, we'll have an SMT again on CPI. You'll see there's also an SMT formed right in here because we had an expansion, an accumulation of the market, and a manipulation. The manipulation phase will be ended with an SMT in the market. Likewise, an expansion in the market will also end with an SMT, which is why on Thursday we wait until the SMT forms and then we get market structure lower, because we're not planning on trading higher on Thursday, for example, due to our objective being met, right? A classic buy week, as opposed to a Wednesday or a Thursday reversal, especially a Thursday reversal. So if the weekly candle looks like this, right, Friday is very likely to expand as well. But when we have a classic buy week or classic expansion week that looks something like this, Thursday is very likely to cap off the weekly range, and then Friday closes back within it. So you wouldn't be looking to long on Thursday or Friday. What you'd be looking and waiting, right, the protocol, which I refer to often as like the weekly range protocols based on AM trades, is you want to wait for Thursday here to cap off the weekly range with an SMT, and then trade distribution back in to the weekly close, which you can see on the right-hand side here is this weekly candle, right? So here is the actual 20 to 30% mark of this candle, coincidentally, right? Because we had a classic buy week, so you can see that the weekly close is right inside of that region. Right now we're trading above it, obviously, but if I just remove this price action from Tokyo, you can see the week is capped off right inside of this range. So you want to look for the distribution back into the range on Thursday, Friday, as opposed to trading long. And that's why we wait for this SMT. That's how SMT is powerful here, because you're going to know that the protocol for the week to end expansion has ended based on your SMT. Without that, you won't know that there's been a protocol to end the weekly expansion. There's one more question. When calculating weekly TJF range, use wick to wick or body? I use wick to wick, so I would look at a weekly candle like this and take the wick low to the wick high, simply because this wick contains the manipulation of the week, right? This weekly manipulation is just this candle actually right in here, this wick. All right, so this is our weekly manipulation. And we need to use that as a broadcast measure because this is where smart money lives, right? So in here, we'll have this projection on the weekly, which is their manipulation. The reason why I don't use this projection, I in fact use this projection right in here, is because this is a measuring gap that is in between. Where was all-time highs? Let's just say all-time highs is somewhere up here. I don't have it marked out. We'll say it's like here, right? This is a measuring gap. Well, that's not the right thing. I should use this. This is a measuring gap. Actually, let me just show you. Sorry. This right here is a measuring gap in between the terminus and the smart money reversal, right? Right in between 0.25 and 0.5. So using swing grading, I like this gap to provide at least 1 to 2 deviations of extension to the buy side, which it does, and then we cap off the weekly range in that region. Instead of using this weekly manipulation, I have a beautiful measuring gap to use, and I even have a breakaway gap to use. But this measuring gap is more high confluence because the SMTs that form in there, right? I could use this projection in here, but the SMTs that form in this measuring gap let me know that this projecting a deviation of this gap is going to be a viable and valuable piece of information. Let me quickly turn off my screen share while I check these DMs. Okay, perfect. So Yusuf's here now. Okay, and the recording is live. So, any videos you recommend for TGIF setups? Yeah, AM Trades does have one. I have one on my YouTube as well. It's a trade breakdown. And also, I think I talk about it a bit in the weekly profile and classic bye week. If those 3 videos aren't clear, I can make a video on it as well. And maybe I'll make a video for my YouTube eventually on that. But I think I have one on my YouTube. AM Trades has one, and it's really just the classic expectation for an expansion week, right? Someone's audio is on, and I'm hearing myself. I think it's you, Ryan. Do you mind if I just mute you quickly?
You said back out?
Yeah. Do you mind if you mute yourself? I'm just getting some feedback. That's perfect. Thank you.
Somebody looking at us from right here, Tita.
Do you have any questions? If you have questions, come off mute. I'm just hearing myself in your mic, and I sound sick and gross, so it's like double in my ear. Okay, cool. Let's get into the lesson today then. And we can talk about any questions we have at the end. Okay. Awesome. Yeah, if you have any questions, just come off mute and ask me. So topic for today is going to be advanced market structure. So I'll just date stamp it as well, just for the recording. Cool. So advanced market structure, or AMS as it's sometimes referred to, right, is the study of a few things. We're going to be studying classic highs and lows, so highs and lows. And we're going to be breaking them up into 3 types. So we're going to have long-term highs and lows. We're going to have intermediate term highs and lows, and we're going to have short-term highs and lows, right? So this is just a study of the different types of formations of highs and lows into the market. And we're going to briefly, again, just as a refresher, talk on breaks of structure versus liquidity sweeps. We'll also include and market structure shifts because they're very similar versus liquidity sweeps. This is more from simple, like not complex or advanced market structure, but simple market structure, right? Then we're going to talk about this in the context of market maker models. And this is the idea that you may have heard from MXM's second trading course, which I will teach you. I've gone through it, but it just really didn't have a lot of, to be honest, in my opinion, a lot of unique value. I did the course and I didn't really find, I honestly was quite disappointed in it personally. It was nowhere near as thorough or as unique as I thought it would be. It was stuff that kind of we all already know and have learned through ICT directly. But I'm not a hater by any means, so I will teach parts of it. But this is one thing I will teach from it, which is the idea that market maker models are swing points. And this is just a fancy way, like a marketing way, right, of saying that we need to consider the interaction between the lows that form in the market and the pivot or context areas for market maker models, smart money reversals, continuations, etc. Right? So if we can touch on these 3 things today, that'll be success for this, kind of shorter lesson. I don't have the ability to kind of stare at the charts for hours right now, but I do have the ability to teach something. So this is the core kind of AMS that you need to learn. And then also, in conjunction to what you'll learn today, there's a really good video by T-Trades, which covers some of the same things in a little bit less detail, which will bring all of your understanding together. So let's jump right into it. Again, if you have questions, just come off mute. It's probably easier that way. Let's jump right into highs and lows. So there's 3 types of lows and highs that we care about: long-term, intermediate, and short-term. Now, the way we're going to interact with these lows and highs in the market is going to depend, right, based on where they're formed and why they are formed, which is why we call them different types of lows. So at the most basic point, when you have market structure that looks like this, right, let's just draw out some market structure for ourselves. And let's go through the process of identifying what these swing points are. So in this case, without knowing anything yet, if you could see this as general market structure, on this buy side of the curve, what do you think we'd call this low in here?
Long-term low?
Yeah, and why is that?
I'm honestly not too sure.
Okay, no worries. Any speculations?
That's where like the buy side of the curve starts.
Sure. Yeah, so let's write down
The
some-
longest. That's basically the longest low before it switches to sell side.
Yeah,
If that
okay,
makes
I like
sense.
that. I like that. So this is the origin of smart money reversal, maybe. 1 second, guys. I'll be right back. What's wrong, Mango? What's up, buddy? Come. Sorry, my dog was whining. He didn't want to hear me talk about long-term lows. He wanted to go hang out with my dad outside. My dog's not about it. Okay, so long-term lows could be the origin of a smart money reversal. I like that. What else did you say? Well, I heard someone say it's like a protected low, right? These are both good things to note about long-term lows. Now let's try and find a way that can, and these are both right actually. Now let's try and find a way that can contextualize why these things are true in the context of market structure, okay? So we do know that long-term lows, right, are the origins of smart money reversals, and they are protected lows on the buy side of the curve. So let's now investigate, like collectively, let's ideate as to why that might be the case. And let's use market structure now as a basis for that argument. So what might the origin of an SMR have with respect to market structure that would qualify this long-term low? Someone give me an answer.
It takes out liquidity, so it's considered like a high resistance. I don't know how to say it, like high resistance liquidity, I guess,
Yeah.
against it now.
Yeah.
And so we hit like the DOL.
I like that. So long-term lows or long-term highs, right? Trade into it. Can we make that a little bit more? Can we make that a little bit more wide-ranging and encompassing by just saying long-term lows or long-term highs trade into a point of interest? Does that suffice? Does that answer encapsulate what you're trying to say?
Yeah.
Right? It creates high resistance by trading into some sort of liquidity or imbalance, okay? So that's our first kind of note about long-term lows and highs in the market is that long-term lows and highs in the market trade into higher time frame points of interest, either liquidity in the form of sell stops or buy stops, or inefficiencies in the form of discount or premium arrays in the market. Cool. That's one. Why did that switch off? There we go. That's one way we're going to qualify a long-term low with respect to market structure. Now, how else are we going to qualify a long-term low with respect to market structure using it's a protected low on the buy side of the curve? So this is one criteria. What else might happen at this long-term low then? If we know that
BSNT.
yeah, that's nice. So long-term lows and long-term highs will contain, or will have an SMT at that POI. Now I'm using POI as a vague term because it could be liquidity, could be imbalance. It doesn't matter what it is. Oh, sorry. It doesn't matter which one it is. It just matters that it's a higher time frame point of smart money reversal. Okay, now let's take a look, right, at what. Now this is the context that's often missed when people talk about long-term lows. They're looking for patterns. So now let's actually involve some of that pattern with this context. What I'm going to do is I'm going to extend.
I'm sorry.
What's up?
So question number 2, just before you move on, does that imply that, I mean, not to like get ahead, but that intermediate term lows and short term lows, SMTs, are not expected to develop?
Well, what do you think about what is it? Well, actually, maybe not at a short-term low. What an intermediate-term low is a different case. An intermediate-term low is very similar to a long-term low, actually. And we're going to talk about that in 1 minute. But yeah, you're on the right track. Okay? That answer your question without being too vague? Or is that purposely vague?
It's all right. We can come back to it when we
Okay.
get to that.
Yeah, we'll come back to it. We'll circle back to that answer, just like a true consultant would say. Let's take a look at what this means in terms of structure usually. So long-term lows, right, also are the origin of smart money reversals, which tend to be a high resistance. So when we look at long-term lows, and now we can actually extend this same conversation to intermediate-term lows, which, by the way, many traders use, right, interchangeably. Some traders don't use the idea of a long-term low. They only talk about intermediate and short-term lows. I like the idea of a long-term low because it's in context of a point of interest. So I will qualify my long-term lows. I'm gonna make sure this is really clear. Let's talk about intermediate-term lows. An intermediate-term low, well, actually, a long-term low / high is the exact same thing as an intermediate with one exception. A long-term low, long-term high must trade into a higher time frame point of interest. Okay? So with respect to market structure, guys, a long-term low or high is the same exact thing, right, in market structure as a intermediate term low or high, but it must trade in to a point of interest. So now what we're talking about is the classic definition for intermediate term low, right? Has two distinct market structure, let's say patterns, that to qualify it. It must have a higher low to the left and the right, which looks like this. I should have taught this intermediate, long-term, then short-term, but it's okay. Hope you guys understand this. In here, do you notice how this low has a higher low to the left and a higher low to the right? Everyone can see that? Is that clear to everyone? Say yes if not. Okay.
Yes.
Cool.
Yes.
Okay. So this is considered to be an intermediate term low. Now, someone tell me why I would call this a long-term low and not an intermediate term low based on what you see on the chart. Let's say it looks like this. Why is this going to be called in our playbook a long-term low and not an intermediate term low?
Because it has traded into the higher time frame POI and there's an SMT.
There we go. That makes sense to everyone? In terms of market structure, right, we have the qualification of an intermediate term low here. Now we just ask ourselves, does it meet these two criteria to call it a long-term low and not an intermediate term low? Yeah. Right, it's the origin of our smart money reversal, right? This is where we're using market structure with market maker models. A lot of times these things aren't taught together, they're taught independently, which I don't think is ever valuable. Everything should feed into our primary model, which is market maker models. So we're going to call it a long-term low if and only if, right, it trades into a point of interest, liquidity on a higher time frame using our time frame alignments that we know of and you've studied, or an imbalance, right? And it's also going to form an SMT in that liquidity or in that imbalance. It's now going to be referred to us as a long-term low, which is the same thing in structure that ICT and Larry Williams teach as an intermediate term low. We're just using a name for it that's long-term low because of the context here, okay? I want you to understand that structurally, there will be intermediate term lows that form and will act as long-term lows, right? But we're only going to call a long-term low if it does these two things, okay? Trades into a higher time frame point of interest, has an SMT in that point of interest. An intermediate term low is the exact same thing in terms of structure, right? It has a higher low to the left and a higher low to the right. And what I'm going to add to this is that the low to the right must occur after a what? What do you think the low to the right must occur after? This is for a long-term low, right? Not a high.
Market structure shift.
Yeah, nice. Who said that?
Dennis.
Nice. That's really good. After a market structure shift. So what I need to see here is a market structure shift. Okay, that's not often taught. That's something that I utilize in my trading, which maybe isn't the way that, well, it's definitely not the way that Larry Williams teaches it, because he teaches market structure a bit different than ICT does. Okay, so an intermediate term, let's just keep this really consistent and just use lows for now, because all the language I'm going to be using is going to be reversed for a high, right? But you understand the point. I don't want to confuse anyone by saying low and high in the same statement. So a long-term low is an intermediate term low at a higher time frame point of interest with SMT. An intermediate term low, right, is a low that has a has a higher low to the left and a higher low to the right, where the higher low to the right has a market structure shift. That is how we qualify classic structure when identifying what type of low in the market exists and how to engage with that low. Again, if price does not close above this high, is this an intermediate term low?
No.
What is it? What is this instead? This becomes a liquidity sweep or a break of structure?
Liquidity sweep.
Yeah, and liquidity sweeps, for example, right? If I have price that looks like this, and let's draw out a candle, and the candle looks like this, right? And we form a long wick here, right? The next low that's put in this point right here, I am not going to trust to hold, because in my mind, price has come off an area of interest. The market structure is still bearish. We've had a stop hunt, and then whatever low is put in here is going to get ran. I.e., this swing point in here that fails to break structure is not valid. I need to see a candle body close through this, indicating change in the state of delivery. So you can also have a SysD in this area. Some traders will use a SysD. Now, because I teach you guys to work on the basis of market structure shift, at least when you're beginning, let's stick with not using changes in state of delivery yet. We're going to talk about that a bit this Friday when we talk about order block theory. We'll talk about what SysDs are and how you can utilize them. But for now, let's take a look at just market structure, okay? We need to see a shift in market structure with a candle body closing above this high, right? Above the wick, for us to qualify this as our short-term low. So now I've already used the language quite a few times. Let's talk about short-term lows. Anyone have an idea of what a short-term low is then? Any ideas?
I guess it would be a low with a lower low to one side of it, right?
To the left or to the right?
To the left. I mean, I'm assuming to the left.
To the right, no?
If we're talking about lows, where is going to be the lower? So let's call this right in
to
here.
the right.
Yeah, let's actually, this is a really good point. So let's call this our long-term low. Let's draw some labels here. This is a good conversation to have, because it will always look the same when you're looking at lows, and it will always look the same when you're looking at highs. It's going to be our long-term low, okay? Now this, let's grab it. What kind of low is this right here? Whoops, where'd my thing go?
That's short-term low.
Yeah, this is going to be a short-term low. So how can we qualify this? How do I drag
Because
this?
there's not a lower low to the. There is a lower low to the right.
Yes, there is a lower low to the right. So what does that mean for a short-term low? We're overconfident.
The liquidity.
A short-term low, right, is a low in the market, right, that is not put in, right? Higher lows to the left and right. Is that a simple enough explanation for us? Can we call every single low that is not put in, right? Higher lows to the left and right a short-term low? Is that valid? Absolutely. That is what a short-term low is. A short-term low is protected or not protected, therefore. What would you guys think?
Not protected.
Not protected.
Why isn't it protected?
Because it's not significant.
It's not high resistance yet, right? What
Yeah.
makes a long-term low high resistance? What is, instead of looking at instead of using the language that market structure fanatics love to use, like higher low to the left, higher low to the right, that's a pattern. What about this low makes it significant?
That we expect a market structure shift.
Yeah, we had a market structure and we purged liquidity, didn't we? We had a liquidity, we had a stop hunt of a short-term low, didn't we? Think about how I've always told you we want to look for continuation purges. What do you think continuation purges are creating?
High resistance.
Intermediate
Long-term
term lows, yeah.
Oh.
Yeah, you're entirely right with that answer. How many of you have thought about it like that before? When we look for a quote-unquote stop hunt in the market, right? Remember, if you've watched my MXM fundamentals, we have these thing called continuation purges. What do those purges do? They create something that looks just like this, don't they? So a long-term low or an intermediate-term low, remember, these are interchangeable. These things look the same in structure. The only difference is that where they're located. So let's just use the term intermediate-term low. We'll call it long-term low or intermediate-term low. I'm teaching you two things here, intermediate and long-term low. Some people don't ever use this word long-term low. They just say intermediate-term low, which is fine. I'm just telling you can use the word long-term low if it's at your higher time frame POI and it has SMT. But let's just say in structure, these are the same things. What does a short-term low lack that an intermediate-term low has, Todd?
In what regard? I mean, like it says there, it's what does it lack?
Yeah,
It's still gonna be part of bearish continuation.
Yeah,
Still expecting a lower low to the right.
it also has no stop hunt associated with it, does it? Right?
Right.
So is it high or low resistance liquidity?
So it's low resistance.
It's low resistance liquidity. And an intermediate term low is what type of liquidity?
High.
There we go. That's the most fundamental basis of market structure when we're talking about long-term, intermediate term, and short-term lows. Intermediate and long-term lows are associated with high resistance liquidity runs. Short-term lows are associated with low resistance liquidity runs. Where do you think you want to position yourself as a trader? Within intermediate term lows or within short-term lows?
Oh yeah, I'm with you.
Obviously.
Intermediate.
Exactly. And that is what we're going to talk about in a little bit when we talk about context of market maker models, and market maker models are swing points. We're going to talk specifically about that statement as to why we care so much about this market structure. So this is also then what type of low here, right here, guys. What type of low is this in the market? Short-term low, right? And then we have, let's say we have a low here. What type of low is this here?
Also,
Short term?
Why is this not an intermediate term low?
Because it didn't take out the short term one.
Yes. And that is why, what do you think is a safer or more probable trade to take? This trade from internal to external, or this trade where it takes out this low. So we have this swing point here, or we have this swing point here. Which one do you think is better?
Bottom.
So
I'm sure
an
you're talking
intermediate term low formed during a market maker model, not at the smart money reversal, we're going to call our long-term low, but inside of a market maker model is the prime area for continuation. Everyone write that down. An intermediate term low or high inside of a market maker model is the prime area to position yourself to trade. You're going to realize just how powerful that understanding is shortly, right? That is going to become the basis of why we consider things like stop hunts, why we look at AMD, why we consider time and price, is because market maker models print intermediate term lows as pivots, not short-term lows. Short-term lows are used as what? What rests below here?
Sell side liquidity.
Yeah,
Stop.
LR. So really, advanced market structure is the exact same thing as identifying what types of liquidity. High and low resistance, right?
So you'd basically always have to be risking your intermediate term low.
You've always heard me say that, right?
Yeah, you said
I-
that on that CPI, or not CPI. What trade was that? Oh yeah, the CPI.
Yeah,
post New York.
all my trades for the most part, you'll hear me say that. I risk my intermediate time frame invalidation, right?
But why wouldn't you put then your stop loss just at that low
Because
instead of being open to a
I
manual
accept
post?
that price can manipulate inside of a wick and still close with the body telling me narrative.
Right, but wouldn't then that invalidate it as a intermediate term?
It's a swing point,
Well-
and the way I see market structure is through institutional market structure, meaning bodies only. I don't consider wicks ever to be a part of institutional market structure. For example, I don't consider where is it? This wick on Tuesday, right, to be a market structure shift lower. Many people would see this like this wick here. Larry Williams would consider this to be a market structure shift below this low. I don't consider that. Where do I consider this candle to actually land? I consider this candle to close right here, right? Which does not break structure below this low, does it?
No.
So I'm allowing for volatility, right, in the market to exist, and using invalidation of a candle body as my thesis. Now that's because I trade during high volatility events, Todd, for the most part, right?
Okay.
So my intermediate low can hold with the body, but it can be invalidated by a long wick, right? And how many times have you seen that?
But we are taking the lows with the wick.
Yeah, always. Same way I look at market structure shifts, right? I don't look at the body here, I look at the wick. I need to see a body closure through a wick for invalidation or validation. It's the safest quote unquote way to trade when you're trading in highly volatile environments in terms of market
Right.
structure, right? It reduces a lot of the noise associated with volatility.
For sure.
So what I'll look for is candle body closures through wicks, like always, and candle body invalidation through wicks. I want to look for events here where you can notice, like just how clear this is, right? So look at this. This was our high resistance liquidity run. Realistically, it was right here. Do you see this like this devil's mark that was stop hunted? This here is the intermediate term low. Do you notice how we formed this lower low here and then this lower low right here? Notice how CPI just creates one large candle that comes through all this liquidity, but look where the body closes, right? You see how it closes higher than our long-term low in this case? These highly volatile events will do that, Todd. They'll create these long wicks. But in the most part, you'll see market structure be respected in the way I'm teaching it, like this. But just for my personal invalidation, I've noticed things like this. So if I was swinging, for example, into this folder right here, I wouldn't have my stop loss below here, for example. I would have it at a closure below here. Does that make sense?
Yeah, for sure. No.
Meaning if the candle closed like this, I'd be out. Okay, cool. So this is how we interpret long-term, short-term, and intermediate-term lows in the market. The inverse is true for highs, right? So now we've also talked about breakup structure and market structure shift versus liquidity sweeps. Now let's look in the context of market maker models. I'm going to get rid of this. I have it in the recording. Okay. Let's take a look at a real chart here and actually bring this into reality as opposed to just theory. So let's take a look at some daily move that I want to project from maybe internal to external. Okay, this would be the completion of an hourly market maker model coming off of this internal range liquidity right here. Let's go down to the hourly chart and kind of look at this really disgusting market maker model. It's really ugly, but I think the premise still works. Let's find something that looks a bit more clear, because this is really choppy delivery. Now, it's all going to work, but I want you guys to have an example that gives you a much clearer understanding, so then you can work out all the nuanced niche cases yourself that look uglier. Maybe something like this. This is also a... Okay, this is cool. This is an example where we have this long wick. I don't want to use an example that's an edge case. I want to use a very clean example. That was an example of exactly what we were just talking about, though, with a news folder coming in and putting in a wick to that long-term low. Where's just a simple expansion in the market? When was the market a little bit more clean? Here?
6 months ago.
Yeah, it's. I mean, it all comes in waves. Like you have to. Yeah, to be fair, I'm just looking for a delivery that's a little less choppy, because I want you guys to see like a two-phase market maker model. That'd be really valuable to see, I think. Okay, yeah, let's mark out both of these and see if either of these are like a clean two-phase distribution. I just want you guys to have a textbook example that then you can be like, okay, it's never
End of October.
It's never going to look this clean, but if it did, right, this is like the textbook. It's the best thing to study off of. I always learn that way too, looking at the most beautiful examples and then being like, in reality, it's not always going to look like this. Okay, here might be a couple of good examples. So here we have this internal range liquidity on the daily chart. It's a fair value gap, right? And we have this high right here, which is a daily external range high. So this should be an hourly market maker model, right, with terminus being this external range. Now let's take a look at how we can use market structure to qualify this market maker model and talk about the idea of market maker models as swing points in this. So I want someone to identify, right, maybe let's start on the sell side of the curve. Or actually, you know what? That can be your homework. Let's just do the buy side of the curve. On the buy side of the curve, I want someone to tell me where the long-term low occurs for them, and then what we should be expecting to see there based on our criteria.
It's like right there where you put your marker. You should see an SMT into a higher time frame PD array.
So let's label this our daily BISI, right? This is condition 1. Let's just call it that. Again, the point of everything you learn here is to find trust in what you're learning through repetition and consistency in delivery, meaning the things you're learning should repeat in the ideal cases. In the non-ideal cases, you have to understand that there is abnormalities, not abnormalities. There is realities of true market structure, which isn't always as clean. But you should be able to convince yourself of certain premises that should remain true. One is that we're going to want to see a higher time frame PD array, and we're going to want to see an SMT. So without looking, if I want to call this a long-term low, right, because SMR requires SMT, we need to see some level of divergence inside of this gap at that low, or else we're not going to call it a long-term low. Simple as that. How about this? Do you guys see this large divergence we have between the YM right here, the ES and the NASDAQ? Does everyone can see that?
Yep.
Okay, cool. That's condition 1. That's condition 2 rather. So let's mark that out and call it SMT and call it condition 2. This is now our long-term low in the market. What must a long-term low have with respect to structure?
Do short-term lows beside it.
Yep.
That's right.
30 feet.
Yeah, I heard high resistance liquidity run and short-term lows. Both are right. Right. Perfect. Now let's use proof by disproof, right? Mathematicians love to do this. Why isn't this a long-term low, guys? Why isn't this here a long-term low? Say there's SMT. There's still SMT, right, at this point in time with the YM?
Because it doesn't have lower low to the left and right.
It does not form a higher low to the right and left. It has what to the right, Todd?
Lower.
So what type of low is this?
Lower than. So that's a short term.
So looking at this, right? Obviously, we know there's no market structure shift or anything. Would you want to trade long from here? We hit the daily fair value gap. Look, we hit the CE of the daily fair value gap. How many traders are going to blindly assume that the first reaction out of this area, right, is going to be the right reaction? Look, we hit the CE here. We hit it to the tick there, right? What is this missing in terms of context to qualify a reversal? Does it have a higher low to the right and left? Is the first question you have to ask yourself. No, it's a short-term low. What do we expect to happen to this short-term low before we reverse?
Liquidity purge.
Yep. We see a stop hunt, and now we see a 3 drives pattern. 1, 2, 3. Now, what do we put in here? That immediately has our eye now fixed for what we've seen different. What is different about this low than this low and this low and this low? What is very different about this low once we get that move in Tokyo?
Higher lows to the left and right of it.
Higher low to the left. And what did I say about market structure?
That
There
the
should-
red arrow is long-term low.
Yes.
The high
There
resistance.
should be a market structure shift from this low to the right. Do you notice how here, is there a market structure shift, guys?
Right. It's putting in the low to the high to create a market structure.
Yes, but there isn't a market structure shift, right?
No.
But what is there? You've heard ICT refers to this directly as something called an early MSS. Do you guys see this right here?
No.
What is this called? Now, this the reason why this example is very good, because the precision here is very, very nice. What is this here called?
Inversion.
An inversion fair value gap is an early market structure shift. So notice how we do not form a market structure shift and a higher low, but we do form an invalidation of the last PD array that's bearish into this area of interest, right? Now watch how the bodies respect that level. The low of this gap right here as a value of price is 17,521.00. The low of this candle with a body, not with a wick, is 17,251.25. Do you see the precision there? What is this telling you about this inversion array?
Be respected to reach buy side.
Nice. Now let's add in what we've learned about market structure and take it one small step further. Just one. What is this here? You're gonna start to see this, guys, all the time.
That's creating.
String low.
It's a short-term low. So it's a short-term. So this is our long-term low. Why is it a long-term low? This is confusing. So let's go slowly. If I can teach you guys this today, we've succeeded. This is a long-term low. Why?
The POI higher time from POI and the SMT.
Fantastic. It also has what structurally, which we need to see.
High resistance.
Short-term loans.
Yep. Short-term low to the left, short-term low to the right, right? With an early market structure shift. Not necessarily a market structure shift, but an early one, right? Now this low in here, when it is, so right now, say for example, we're looking at price, and price is right here. I don't want to go too far. Price is right here. We might assume that price could reverse from here, couldn't we? Because now we have a long-term low. Now, once we see this stop hunt. Inside of our point of interest, remember what I said about market maker models are swing points. Inside of our reversal, our long-term low. So the dealing range of our long-term low to our current market structure, let's look at our dealing range. Once we put in a low and we purge this low, remember you've always heard me talk about stop hunts, and that's how you get involved in market maker models. What does this low become in here? I'm going to make this a different color. What type of low is this?
Intermediate.
Intermediate term lows are what with respect to quality of trade? High or low probability trades?
High probability.
High probability trades. So this in here, this this discount stop hunt of a short-term low. We have a long-term low, shorter term low to the left and right. Now we have an intermediate term low formed. Let's take a look at the chart. Look what forms. Again, you're not trading the London session for the most part, but look at how time and price are so related. What do you notice in between this area right here? Do you see this SMT?
No.
Okay, so now let's put everything we know together. We have a long-term low, signifying what? What do we say a long-term low is in context of a market maker model?
SMR.
Smart money reversal. Okay, we know our target is going to be this line up here. Now we form an intermediate term. I'm going to get rid of that. Actually, let's keep it. Now we form an intermediate term low. Where on the chart do you believe the best place for you to take a trade is? In this in this price action, where is the most structurally aligned place for you to take a trade?
Last short-term low, respecting the
Yep.
intermediate term low
Yep, right here.
with SMT.
So we can write this out. The best place to trade, in this case, it's going to be long, right? Going to be the short term low to the right of an intermediate term low or a long term low. That doesn't matter. I'm just going to use the term intermediate term because we know the difference between these, right? Inside a kill zone with SMT. This is where the optimal entries for your market maker models will form. Remember, it's all fractal. We're going to be trading to these highs. This is the double purge theory, right? External range taken, buy side, then sell side with SMT, LR to this high, and even more LR to this side. But this is the fractal that you want to be trading right here. Why? Because the best opportunities for longs are going to form in the short-term low to the right of an intermediate term low inside a kill zone with SMT. How do you know this intermediate term low is going to hold? Well, what do we have to the left of this intermediate term low?
Long-term low.
Long-term low. Now let's see the index, which did sweep this low, and then analyze why this low wasn't respected on the YM. You can see it. Does the YM at this point here put in a long-term low?
No, because that's the one with the SS. That's where it connects with SSMT, no?
Yep. So first of all, it's involved in the SMT, right? You could still say that's a qualification for a long-term low, but does it have a higher low to the right and left? You can see there's a higher low here, right? And a higher. So let's mark it up. There. Oh shit. And here, right? We do the same thing. And then where's the other low? It's right here. So you can see we have our quote unquote long-term low is in our daily PDR. Let's see. Where'd it go? Actually, I can just prove it to you by looking at this. What do you see right here that we're missing to qualify this long-term low? I'm gonna zoom in right here on the YM. What are we missing in here that the Nasdaq has?
The PDR is missing.
Yep, the daily FVG, right?
Yep.
Well, yeah,
Is there a daily
F quite a bit lower, but I think that's the SSMT aspect, no?
Yeah, that's the SMT. But is there a date?
No.
Is there a higher time frame point of interest to qualify this as a long-term low on the YM?
No.
Doesn't look like it.
What about on the ES? Is there a higher time frame point of interest to qualify this as a long-term low?
Yes.
So where do you think the divergence is going to form between what indices? Which one's going to sweep this low to form the next leg higher?
YM.
Because YM doesn't create a long-term low here, does it?
Well, it still needs to order pair.
Whereas
Mm.
ES and NASDAQ both have the conditions, right, to create, where'd it go? Both have the conditions in here to create this long-term low. They have this daily fair value gap. So when we see this SMT, this is all narrative. Again, none of this is pattern-based. This conversation we're having is not pattern-based for a reason. Right? So what we have to recognize that when we see this SMT, which sweeps out this low with the Dow, right? That SMT in here, which is also this SMT in here, same thing, right? When we see that, this short-term low is the best place to engage the market, okay? So this is a note you can have from this lecture. The best place to trade long is going to be a short-term low to the right of an intermediate-term low inside a kill zone with SMT. So let's get rid of all of this and find more examples to prove it to ourselves. So let's keep our long-term low actually on the chart.
But I'm sorry, just to be clear, maybe you understood what I was saying, but basically that's the connection of market structure with sequential SMT, right?
I wouldn't even say sequential SMT as I would for the conditions needed for a long-term low. Like we're going to have local SMT, but this sequential SMT doesn't always have to take out this low, Todd.
But I guess what I mean, by the fact that YM didn't create a long-term low is because it's the one that didn't hit the high time frame point of interest. So then thus it didn't create the long-term low.
Yeah, that's why on YM, for example, you wouldn't trust that low to hold.
Right.
Because it just doesn't meet those conditions, right, of having that higher time frame array.
Right.
Does that make sense?
Right.
But you're right. It does have something to do with the SMT as well, because the SMT then order pairs on YM.
Right, yeah.
But if we're looking for something more like concrete to use in our analysis, we can say we wouldn't have expected that low to hold on YM. Why? Because it didn't do what?
It didn't hit a high time frame point of interest.
And I know that's a rule. That's not always true. But when we're starting, you have to use some rules. Now, again, most of the conversation today, like it always will be when I teach, is based on narrative. It's based on understanding that when you see this, with everything we just talked about, using that context, this is a very high probability candle to be involved in. Then it doesn't matter what your entry is. Go down to a lower time frame, find an entry. It doesn't matter. You're on side with this move. Notice how the market's not moving here. The market's not moving here. This is chop. This is where you lose. But when you can align yourself with structure, right? Short-term low purged. So we created what? HRLR. Then we create a short-term low. Inside of this expansion is where you want to align yourself. And there's opportunities, guys. Say you're simply trading the hourly chart. Wait for this SysD, retest of this order block or this breaker and get involved. There you go. That could be your whole model. This could be your whole entry. There you go. You want to go 2-1? Find wait, you want to find 2-1? Okay, where do you have to risk? You want to risk that low. And now you want to target 2-1. There you go. This can be a whole trading model, never deviating from the hourly chart. Understanding market structure, complex or advanced market structure will help you here, because some people will not try and trade that move, but they'll still trade this move lower. They'll trade this move higher. When this move higher, right, first of all, isn't a confirmed intermediate term low, meaning that this low can be attacked. Once we see the short-term low get formed, this next move is the one you want to align yourself with. This move here, this candle, and this candle are high probability, extremely high probability. This short-term low here, extremely high probability. This is the early entry, right? You're anticipating this low to like hold because now we have an intermediate term low. So we have a swing point in the market, right? Higher low, lower low, higher low. So this candle on a higher time frame, right? It's going to look like a 3-bar pattern that looks like this, right? Which Larry Williams classifies to be in, then out, then in, meaning it's a high probability reversal, right? Now we're combining market structure, but now if you want to trade this candle, you can, right? This is also a high probability candle because we've confirmed it with the structure. Trading this here, right, is the turtle soup traders. This is where turtle soup traders want to get involved, pinpointing the low, the long-term low of a price move. But that's why we always say wait for market structure, because you notice in here, if you traded, right, this low, you would get absolutely destroyed because this low in here needs to be purged. And now this low, and this low are opportunities to get involved. Early entries happen here, right? Because we're using the narrative that this is going to be our long-term low. So this should form an intermediate term low. You're predicting that, but you don't need to do that because you can wait for it to be formed and trade the resulting retracements. That's the structure component of market maker models that's often forgot. And this is a more complex topic, right? It's about pinpointing where you want to get involved in market maker models, because this is the smart money reversal and the low risk entries here. But if you don't want to get involved in this low risk entry, you have to realize there's opportunities that are going to be more structurally aligned once you get this low forming here, this low forming here. Again, where's the market structure shift that happens? The true market structure shift happens right here. And once we get this market structure shift, right, then you want to enter on a discount array. A discount array could be this volume imbalance, which you'll notice never gets violated. Price trades into here, forms SMT, boom, you go long. Cool. Let's take a look at more stages of reaccumulation in the market and how it forms that same structure. So again, we have now closed above this high, right? We're going to again include this as our break of structure. Now, if you guys have watched market maker model theory that I've taught, let me, first of all, this will be a BOS. After we break structure here, right, we now expect this area of, what is this called right in here, guys? What's this candle called?
Breaker?
Yeah, breaker or mitigation block.
Breaker
Right?
block.
Breaker block. We expect this breaker block to offer what in the market? Reaccumulation, right? You want to drag out points of interest on the left side of the curve to the right side of the curve. That's the fundamentals of market maker models, right? Old selling, new buying. And we're not sweeping this high, we're closing above it. And because we're closing above it, we expect higher prices. What's the draw on liquidity? This daily external range high, which we'll mark out in red, so it's very clear. Okay, so now we have, in terms of dynamics, we have this smart money reversal down here. Smart money reversal. The low risk entry we defined, right, is going to be this entry right here. I'll use just an arrow for that. Right? Intermediate term low. Short term low. Short term low. So this was an area to get involved in price, and somewhere in this low risk market structure aligned buy. Now we have our first phase of reaccumulation. What do you think the optimal entry is going to be inside the first phase of accumulation? What did I say down here? What is the best entry? Someone say what that note said.
Intermediate term low?
Yeah, to the short term low to the right of an intermediate term low, right?
Mm-hmm.
Okay, so let's do the exact same process and prove it to ourselves. Prove it that that entry is the most optimal entry. Let's mark out, right, an intermediate term low. So in here we have this Tokyo session We create, what kind of low is this?
Short term?
Short term. Do you want to get involved in the short term low?
No.
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 So let's all go through this exercise together and prove it to ourselves why we can be patient. This is why you'll see me being patient often when I'm looking at market structure. Okay. Don't want to get involved here. What kind of low is this? I'm going to consider this to be just time distortion because we're not moving. What kind of low is this?
Short term?
Short term. Let's see. Let's look to the left.
Intermediate, right?
Tricky. Why don't we call this an intermediate term low? What doesn't this low to the right do, which is so important that no one teaches it? I just told you it needs to happen. What needs to happen?
Doesn't
for this?
purge.
Oh, market.
Doesn't
structure.
purge.
Market structure shift. We have a purge,
Ah.
right? We have a. Do you see the purge right here? This purge right here?
Yep.
That's a good purge. What does this low not do that we said it must do to be a higher low to the right of an intermediate term low?
Eight. Oh, market structure shift.
Yep. Does it break structure? Nope. Right, by the time this low was formed, has it broken structure above that high?
No.
No, we can see it very clearly as not broken structure. In fact, we put in a higher high, right? So now, what kind of low is this? Everyone should answer the right thing now. Everyone, what low is this? Intermediate, short term, or long term? There's only one answer.
Intermediate.
No.
Short term.
Short term, right? If we had broken structure, with a body, then what would it be?
Intermediate.
Intermediate.
Yes. So seeing this is how I can come into the day and know we're going to sweep out all this liquidity and this low is not going to hold. It's why I'll get an intuition, because in my head, I start to visualize market structure without drawing arrows. I don't draw arrows like this on my chart ever, but I'll look at how price action has interacted with lows and highs. Are we displacing? Some people like Casper will call this a failure to displace. That's a very valid way of putting it. But if you want to look at structure, it's actually more simple. We are failing to break structure above, very specifically, above the short-term low. Short-term low, intermediate term low. If that's an intermediate term low, this next low must be a low after this structure is broken. That's going to confirm what has happened after we've had this liquidity sweep. What's that going to confirm if we break structure above these highs?
Intermediate term low.
Yeah, smart money reversal, right? Inside of this breaker or inside of this large fair value gap, right? But we don't get that. So this becomes, in our mind, liquidity. Now look at what happens. Short-term low. Low. Now we already have a suspicion based on our what model does this look like? What does this kind of look like to you guys? 3 words, 3 letters.
The box.
PO3.
AMD.
Power of 3, right? PO3, AMD, the block setup, yeah. I mean, you wouldn't probably need to see the next short-term low print here to know we're not coming below here. I'd hope not. But look at how the market does not reach into the liquidity yet. Do you see that? People will FOMO this type of day. And there is entries in here, by the way. And again, I would take an entry right in here because I would be playing AMD. And I'd be hoping for this high. But the market books market structure. The market books what we're seeing like this. So we wait for the intermediate term low to be validated with what? A short-term low. Where did I say the best entries are? What do we say down here? Someone read out that quote I said. Where are the best entries?
Yeah, short term to the left, to the right of intermediate term.
Perfect. Let's use that exact same quote. The best entries of a market maker model are the short term to the right, of a intermediate term low. Short term to the right. Are we trading during Tokyo? Hell no. Are we trading during London? Of course not. What is created here? Another set of accumulation, manipulation. Now this is the confirmed low. Higher low, lower low, higher low. This in here is called what distortion? What's happening in this entire session?
Time distortion.
Of course
Time
it's time
distortion.
distortion. Of course you're not trading this. You're going to trade alongside the New York session and the volatility driver of the day, which I'm sure one exists at 10 a.m. based on this reaction, right? Maybe, or it's just a Monday and we're accumulating. Yeah, it's a Monday, so we're not even going to trade Monday. We're going to say, screw it, Monday's non-existent. Just going to wait. Again, we have our intermediate term low. And let's actually, you know what? This might be a daily inefficiency. Oh, it's not. It's an immediate rebalance. Okay. This almost formed another long-term low, but we'll call it an intermediate term low for now. There's no reason to change the name up, but it's very close to being a long-term low that we formed right here. In fact, I would call this long-term low because it's a daily immediate rebalance. But let's keep going with the logic. So we're not trading Monday here. Right now we have a confirmed intermediate term low. We come into Tuesday. The best opportunities, right, are going to lie in here. So if you take an entry here, what you want to do is somewhere in this candle, you want to involve yourself up to this daily ERL. Again, risking a closure below this low. Notice how we don't come below this low, right? We form a swing failure to this low. We might even form an SMT to that low. But all three of these lows could be held because what? It's a protected low in the market. And you'll notice what happens with all three of these lows. Do any three of these lows get violated before we run ERL?
No.
No, it's a protected low in the market. Right? Look where the SMT actually occurs. The SMT occurs at which low? Which low do you think out of these three lows?
The long term.
Or the intermediate term one here, right? Again, I don't mind using the word long term. It's the same thing.
Oh yeah, whatever. Yeah.
No, would you look at that? So there's the SMT. So that's your early indication of an intermediate term low. Now it's not confirmed until what? We put in.
But also,
Yeah, it's up
oh,
over.
I'm sorry, Fees, if you don't mind can you put those put YM back up on the charts for a second? Which I guess also is the case, right? Because then YM doesn't put in a long-term low then because it's not the one that swept liquidity, right?
YM here this isn't a long-term low on YM because we don't put in this higher low to the right. Do you see that? It comes in and sweeps. We have another SMT formed.
Right. Well, that's what I'm saying. So I'm saying because it's the index and sequential SMT that doesn't sweep, it's not putting in what we can expect to be a protected low.
Yeah, you're combining sequential SMT concepts, which I'm not trying to do this lecture, but I think there's an argument there.
I'm sorry, I apologize. It just seems really. They seem
It is
like
interesting.
related
What I would
narrative-based.
prefer you think for the purpose of this lecture is just to say this isn't an intermediate term low on YM because it doesn't
Right.
put in a higher
got you.
low to the right. When we put in this higher low to the right with SMT right here, we know this low is not going to be broken, right? Now we know for a fact that this low is going to hold because we put in that SMT.
Sorry, man. It's kind of interesting the way it all goes together.
Yeah, it is all. You're right. There is something called sequential SMT happening here, but you don't need to know that at all, do you? So you know that where is the highest probability entry in this low right here, right?
Yeah.
The low to the right of the intermediate term low. Fantastic. Using that logic, you're going to align yourself. You're going to be on side with the right trade idea more often than not. Like the highest probability trade was here, so we'll circle them. High probability trade. High probability trade. Now the draw hasn't been met yet, right? So what do we think we're going to look for on Tuesday? Same thing, right? Let's go through it. We have a low right here in the London session, okay? What kind of low is this, guys? Everyone say
Short term.
Short term, right? Okay, everyone, short term agreed. Nice. We have another low here. What kind of low is this?
Short term.
Do we know it's going to be a short term low yet if we hadn't seen what happens to the right? No. But do we know it's going to be an intermediate term low? What's the early
Yes.
indication that this isn't going to be an intermediate term low? What do we usually see at intermediate term lows?
One thing
Prime
on
interest.
M2, it's,
Oh,
it
wait,
hasn't done market structure shift.
yeah, and we had no market structure shift. Good eye. We also had no SMT, didn't we? We had nothing here with SMT, right? So nothing to really corroborate that this is going to be the short-term low. And this is where people get baited in. Here at 9 a.m. or 8 a.m., right? Right here when the market opens. This is where they get induced. Then we come in and we create another low. Now we have something interesting forming, because what happens, let's zoom in right here. Zoom out a bit. What happens at this low right here? What do we form?
SMT.
Huge SMT, right?
Mm-hmm.
Okay, now we have an early indication of what type of low is forming. Early indication, we don't know yet. Yes. Do we enter here? This is where people will enter early, like you'd enter early here. The opportunity lies here. The best opportunity. The best opportunity lies here. Some people will enter here. Now, here's where you'll enter early if you can see it all. And that doesn't, and also it's the end of, it's like Tuesday, it's Tuesday at noon. You're not going to enter. I wouldn't enter. I'd just wait. For what? Now look what happens. Where do we say again, the quote, where do the best entries lie on the chart? Someone say it out loud.
Short-term lows off to the intermediate term, to the right of the.
There you go. Are you going to enter during Tokyo during this short-term low? Of course not. Why would you not? For example, why would you not enter here? What is not aligned for you right here?
Time.
Yep. What's not aligned for you in London session?
Time.
Time. There's a high impact folder today on this day. Or if there's not, it's still the New York AM kill zone. We don't trade these sessions. We don't do it. So we wait for the next low to be put in. Now London forms this low at 3 a.m. or 2 a.m. London low of the day. You're not around for that. You're sleeping. But what do you wake up to see? This pattern, don't you, right? Low, intermediate term low. With what? SMT. So when you see this low in London coming into New York, do you think New York's going to come below here?
No.
No. So where do you want to enter? The next low that's formed. High probability. So look at your chart, right? You'll see it again right here with the ES. Here's your SMT that forms, right? Once you see this SMT form, you want to position yourself in this candle right here. There you go. Best opportunity, because we know we're not coming below here. So we're not going to get SMT swept below here, but this SMT is telling you that the move is happening because we have what? Intermediate term low. So again, repeat in your mind, the best trade thesis is to the low, to the right of an intermediate term low. There you go. That's the best trade thesis. Notice how we have the SMT here, intermediate term low preserved. Notice how we have the SMT here, intermediate term low preserved. SMT here, intermediate term low preserved. To the right, the low that's put in, you see an SMT, perfect entry. This is market structure, and the market books this way because this is the first stage of reaccumulation. So what do we call this in a market maker model? What's this called? This area.
Second.
This is called the silver bullet. LR generation should be right above it. What do you see right here, guys? What is that?
Equal, relative equal highs.
Look at how the market prints market structure in context of this move. I'm going to draw it out for you. Doesn't that look like a perfect let me delete this. Doesn't this look like a perfect market maker model to you? It's two phases. It's perfect. It's symmetrical. Do you see that? First phase, second phase, first phase, second phase. Do you notice where these swing points are occurring? Where are these swing points occurring, guys? Inside of intermediate term lows. Do we see that?
Mm-hmm.
So market maker models are swing points. When people say, when MMXM Trader says that now, does it make more sense? How we're creating swing points and then we're moving away from them. Let's do another example together. And then we'll call it.
I know he also talks about in his course he said something like when two short-term highs are formed and an intermediate term low takes it out, it's like a second stage distribution.
When two short-term highs or lows are formed?
Two short-term lows in the buy side actually.
Yeah.
And then intermediate term low sweeps it. That means the second stage is coming.
Yeah, so it looks like this. That's what we saw in both examples, right? We had two of these lows, and then we had a real intermediate term low, right? And then we had a higher low to the right. And where's the best place to enter? Right there, right? Is that what he teaches as well in the course?
Yeah, something similar to that.
Yeah.
But it's just a way of telling when the second stage is basically going to be.
So this is where you want to enter, right? But you want to wait for market structure to show you that. So we can look at, again, this really choppy example. So let's say this is a classic Thursday. So this is a consolidation reversal. So we expect Thursday and Friday to expand, right? Opening, low, high, close, and then we get that Thursday, Friday expansion. So right now, immediately, what type of low is this? Intermediate or short term? We'll start with that.
Intermediate.
And does it meet the qualifications for our long-term low? We have one qualification here, right?
Yes.
Okay, what's the other qualification we need to see then?
SMT.
Cool. 1 second. Can we see the SMT?
No.
Okay, with the Dow, right? There's our SMT. So this is now called our long-term low, which is just a form of intermediate term low. Now we have a low that's confirmed higher to the left, so that one's easy. All right. Now we have a low to the right. Long-term low. The best place of opportunity to get involved is going to be in this candle to the right of this intermediate term low. Meaning, what do I want to see in this candle? What do I want to see right here to get involved, guys? What do I think there should be right here?
Market structure shift.
Ah, do you notice how we get it? Look at the difference here, where this one actually works. See the market structure shift right there? What else do we get? Remember I talked about early MSS? We get an inversion, right? You see that? Inversing this PD array and then shifting structure above this high. Now, there's one other way that you can qualify an intermediate term high, and you guys have probably heard me talk about this before, which I was going to leave for another lesson. But an intermediate term high or low can also be a low that comes into an inefficiency, right? It doesn't need to have this lower low to the left and right. It can also just be a single low like this. You guys have heard me say that before, right? Maybe in stream or something like that, or my older students. This, for example, right here is an example of an intermediate term low as well, because it comes into this inefficiency. Now, what we want to notice about here, before we get too sidetracked, is that what do we expect to see in here? Someone already said it, MSS, which makes this is a good low to get involved in. Right, we've also purged liquidity in this low. Liquidity sweep right here. It's a continuation purge. Now, why don't you get involved here at this 5 a.m. low? What's missing from this 5 a.m. low? Two things. Someone tell me. Why don't I get involved in this low? Afiz, it's so hindsight. You're choosing this candle low, but what if I only saw this candle low? Tell me why I wouldn't choose this candle low. Time? Good. What's the other one? Yeah, time is one. What's the other one? It's written on the chart.
The shift.
There's no market structure shift. Yes. That's why it's not hindsight. I'm actually telling you this because I tell you this all the time. You wait for market structure. Now you get a stop hunt. What else do you think you're going to see right here?
SMT.
Yes, 100%. You're going to see SMT. Let's prove it to ourselves. Oh no. Oh, it actually happened right here. There we go. See the SMT? Forming at the low? Everyone can see that?
Yep.
There we go. Conditions have been met for this to be a high probability entry. Swept liquidity, market structure shift. What does this become? Remember, we have a low here now. Now we're tying it all together. What does this become? When we put in this
High
low?
probability entry.
Yeah, and then what is this? What is this formation right here? What is this forming?
Intermediates.
Market maker
Term
models
low.
are swing points. Do you see that? The movement, the origin of this move is the creation of this swing point. Do you see that? Intermediate term low. Now it's confirmed here. And what's even more beautiful about that, which makes it even more complex, is that we form another SMT right at this short-term low. Do you see that on the YM? This entry here is incredibly high probability as well. Remember what we said, what are the highest probability entries? Notice there's two entries here. Why is this entry here high probability? In terms of that quote I said, where are the highest probability entries? Someone say it to me word for word.
Short-term lows to the right of intermediate-term lows.
What is this right here? An intermediate term low, correct?
Low.
What is this right here? The short-term low to the
Intermediate.
right of that intermediate term low, correct?
Right.
Now look at the beauty of this. What does this short-term low to the right of this intermediate term low get created in this move right here? It creates what? A new intermediate term low, right? So where's the
Yeah.
opportunity going to rest? In the
the right.
short-term low to the right of the intermediate term low. And what
So
do
that
you
one.
see here? Another SMT.
Well, that also becomes an intermediate.
Ah, now we're just juicing
me?
it. Do you look? So when people say, right, market maker models are swing points, do you understand what that means now? Now everyone should say yes. Everyone understands what that
Yes.
means. Because look what is happening. Right? This is not a low even. Nah, this is an intermediate term low because
Hafiz, can you hear me? Can you hear me?
yeah, I can hear you.
Yeah, just a quick question. For that down close candle, you marked the arrow, right? For the two candles before, the black color arrow.
Yep.
Yeah. So that one is not really a swing point, but like, do you consider that one of a short term low because it's a down close candle?
It is a swing point, right? If we do the paintbrush method, we come in, we form a low, then a high, then a low, then a high.
Okay.
Right?
But
And
on this time frame, it's not a swing point. Right?
it is.
Like,
It is.
on
It's just a higher low to this low. Remember, the low isn't here, right? The low is down here.
Okay.
So
yeah.
look, paintbrush method.
Yeah.
We come up, we form a high. Now we form a low. Now we form a high here.
Okay.
Form
Yeah.
a low,
By that.
form a high,
Yeah,
form a
so
low, right?
yeah. So on a lower time frame, it would be a more
Oh yeah, on a
obvious
lower
swing
time
point.
frame, you would see this is a complete like swing low. Yep.
Complete swing point.
But that's why I teach the paintbrush
Okay.
method, which is why this is the second lecture on market structure, not the first.
Okay. Thank you.
Yeah, no worries. Good question. So do you notice how this is all forming swing points in the market? These are our entries. So look, intermediate term low, short-term low, short-term low. Here is not the ideal entry because it doesn't meet our rules. What don't we have in here? What don't we have?
Market structure shift.
Market structure shift. You immediately ignore that low. But when we sweep that low and we form SMT, now what do we have qualified right here in our mind? A potential intermediate term low. Meaning what's going to be the best entry?
Next short-term low.
Boom. That next short-term low should be expected to do what? Form what?
SM.
Oh, there's the SMT. Perfect. Which in and of itself is now forming a new what?
Intermediate. term.
Intermediate term.
So an intermediate term low can either be this thing, right? A low with two higher lows, or it can be a low that rebalances a PD array, right? Have you guys heard me say that before, or is this brand new? I've talked about it a lot on live streams, but an intermediate term low can also be a low that rebalances an inefficiency. Do you notice how this low here doesn't have a higher low to the left? Notice how there's no higher low here, right? But do you think this is high or low resistance?
High resistance.
I lost Todd. Todd, do you know how do you notice how there's no intermediate term low to the left of this low? Oh, there's no short-term low, rather. There's no short-term low.
Right. So it's going to be.
So you wouldn't be able to call this an intermediate term low traditionally, would you?
Right, but because of the fact that it rebalances.
Yes, because it comes into this array, we can call it an intermediate term low. Is everyone okay with that?
Yeah, that part I got. Yeah.
Yep.
So now we form another intermediate term low, which means where's a good entry point, guys?
Low to the right of it.
The low to the
Short-term
right of
low
it.
To the right of it.
Are you going to enter during the Asian session? 2 p.m. right here.
No.
Good entry. Right there. Valid. Look at that beautiful entry. From what to what? Now we're combining more concepts. What is in here? Fair value gap. What does fair value gap go to? External range high. Do you see how beautiful this market maker model here is right here? Do you guys see that? Internal to external? Everyone sees that, right? This fair value gap. Right?
Is there anything to be combined with the fact that that doesn't become a breakaway gap?
Which one?
The displacement candle?
This one?
Yeah.
It doesn't become a breakaway gap because we've liquidated all of the draw. Do you see all the draw for the day? So now most of the daily draw has been liquidated. As you see, the majority of the move happens into the PM session in Asia. What happens after the draw has been liquidated? Now we'll return back into inefficiency because price is only doing one of two things ever. What are the two things it's doing? Seeking liquidity or offering fair value, right?
External to internal terms.
Yeah. So in this case, if we say, for example, we put in a failure swing right here, then we'd probably have a breakaway gap reaching into that liquidity, right? But this here is the draw for the next day. So for this day, right, we come back and we re-offer fair value. What's another way you can tell? Look at the way this third candle opens. What does it open with? No wick.
Yeah.
Right? Also, another way you can tell. Once this third candle closes, right, does the fourth candle form SMT and up here? Let's see. Oh, that's pretty telling. See a large rejection right here of this candle on the YM?
Mm-hmm.
So what kind of... Look at the delivery of this candle versus these two candles. What's that telling you? Look how this is a doji, and these are up-close candles.
Right.
Price doesn't want to go higher than this on YM immediately. You can say that, right? Mm-hmm. Devil's mark, and then this candle fails to displace much higher, right? Internally, you can see on a lower time frame, we're not displacing any higher. So that's why breakaway gaps sometimes aren't breakaway gaps. And the best way I say is a breakaway gap will stay that way until what's met.
Yeah, no, I'm sorry, draws met. I guess I was just relating it to the fact that it's rebalancing that and putting that intermediate term low. I just was kind of trying to see those two principles.
Yeah, and here we're forming an intermediate term low as well. That can be used for the rest of the day to move higher.
Right, I got you.
Right, and also, you notice we're not closing above the liquidity here, are we? Are we wicking liquidity or closing above? That's a very important question as well.
Yeah, wicking, yeah.
Yeah, usually a wicking of liquidity means we're going to return back into the range. But then even more so, let's look at the candle bodies. Look what's happening with these candle bodies. Sorry, let me pull it to the wick. Right? The candle bodies are forming a what in this area? Let me just draw it out the way that ICT draws it out from this to this.
Rejection block.
Yeah. So there's about 10 reasons you could say this might come back down into the range, right? But again, that's combining a lot of different stuff.
Hafiz, just one more question.
Yep.
If you don't mind. So, can I consider the 7 a.m. swing low as a strong protected low, or is it better to keep my stop losses as at a long-term low?
What'd you say? A what swing low?
There was a swing low at the 7 a.m. just now, right? The intermediate term low.
Here.
Yeah,
I
that
would
one. Can
I would put my I would put my swing.
losses?
Yeah, I would put my stop loss below the low that has SMT. So in this case, it would be this low right here.
The long-term low.
Yeah, the
basically.
long-term low. Long-term low is the safest because it has our SMT that we've confirmed.
Right.
Yeah.
Okay.
Good question. That's personally how I would manage it. Some people would put their swing low stop loss right here. I would just personally move it here because it's safer for me. But now let's just finish off this example. Here we form an intermediate term low, which we agreed is because we rebalanced an array. Where's the best entry, right? On the chart, guys. Should be like a mantra in your head now.
To the right, yeah.
The low to the right. Are we inside a kill zone? Yep, we're in the New York PM kill zone. And then we combine. We're not just randomly using this logic. What logic are we using here? What is this right here?
Busy.
Internal to what?
External.
Do you see how we're combining swing points with market maker models now? High probability swing point, high probability expansion. This fair value gap works because it's part of a context move in the market. It's part of a market maker model swing. Swing low. Next low offers IRL to ERL. Boom. This low offered IRL into what? Notice, what did this low offer the draw on liquidity, which is this IRL? Or did it leave a failure swing? Someone tell me. When we trade into this internal range liquidity right here, when we trade into this fair value gap right here, are we given, make it the same color, are we given this swing high after? Yes or no?
Yes.
Not
That's the
before
external range.
Not before trading into this fair value gap though, right?
Right.
So what does this leave in here? What is this called?
LR.
A swing failure, LR, right? So then what does price do? It comes back into the inefficiency and then redelivers the external range, internal to external, using this swing point right here. That swing point right there. Now we form an intermediate term low. Let's keep using this logic until the draw is liquidated, which is here. And then it actually goes higher. So let's use the next day. So on Friday, because we had a high probability reversal day on Thursday, remember consolidation midweek reversal, what does that lead to? Friday expansion in most cases. So in here we form, in the London session, we have this low. What kind of low is this?
Short term.
Short term.
Short term.
What kind of low is this?
Short term.
Short term.
What do we say short term lows are?
Low resistance.
Yep, liquidity, right? So when we sweep the short-term lows, what do we expect to see here, first of all? Let's just work in chronological order the same way. See, notice how I'm just repeating the same exact things again and again and again. What do we expect to see right here?
SMT.
Do we not get any SMT?
Yes, right? That one doesn't get taken on yet. Oh, right? Yeah. Oh.
No, it doesn't. That's interesting, actually. This might be an example of a case where I wouldn't have seen it. Oh, wait, we do take it. We do take it. What am I talking about? Right here on the Dow, we take it. There we go. Sorry. I just wasn't paying attention. Because the Dow puts in these equals. I can't tell if it's equal or we take it.
Just look.
Wow, that's close, eh? I think we must take it by like a tick. I actually don't know. It might just be genuinely relative equal. That's okay. Again, we were gonna put in another low here. Let's assume that Dow takes it, but I'm not entirely sure. There's no SMT there for now. Let's just say there's no SMT there. So it's not necessarily a confirmed intermediate term low, but then we get the nail in the coffin. Where's the best entry, by the way? Let's keep going in our logic. Where's the best
To the
entry?
right.
To the right, right?
Right. Which is where the Dow
Which is
does-
where then, okay, then if you have any doubts, are your doubts cleared up now, seeing this? Everyone's doubts are cleared up, but where is a good entry once we see this? Huge SMT, right? Massive SMT. Fantastic. This is a good entry. Position yourself somewhere in here. Market maker models or swing points. So now this is confirming a high probability swing point in the market. Boom. Notice how we utilize these short-term lows as what?
Liquidity.
Yeah. And notice how this short-term low does. What's the difference between this short-term low, right, and this short-term low? Tell me. Why is this one high probability and this one just sucks wind and dies? And this one sucks wind and dies?
Because
Intermediate.
What did you say?
Because the
Time zone.
intermediate term low is
Yeah,
protecting it.
it's because there's no intermediate term low that you're using as narrative, right? Do you see how this is narrative trading? Like advanced market structure is really using narrative. Whereas longing this retracement, people might say like ICT is broken. Look, it comes into this fair value gap. It actually doesn't. But say it comes into this FVG. In fact, what do we know this to be right here? What kind of model is this called? Of this fair value gap. Putting in these failure swings to that fair value gap. What's that called?
Inducement.
Yeah, this is the inducement model, right? We've learned that before. But say it comes into here in London session. People are gonna be in hissy fits because price will do this all the time. Go in your charts and backtest. Don't take my word. Price will do this. Right? And they'll be like, oh, well, it came into the fair value gap and then it still stopped me out. Of course it did. You're longing a what? You're longing a short-term low. Just because it rebalances this shallow PD array here doesn't mean that it's an intermediate term low. That is very different than this. This is an intermediate term low because this is a deep, full retracement of this huge inefficiency, right? That's an intermediate term low. Here, short-term low, liquidity is being generated, liquidity is being purged. Take your entry right here and ride the wave. Okay, so this is advanced market structure. If you want, we can do one.
I have a quick question of these. So going back to the rule, I know ICT says that when a fair value gap is rebalanced to the 50%, it's basically balanced. So is it possible we can say that when a low comes to the 50%, because it's balanced, it is an intermediate term low?
I would not use a pattern. I would instead say focus on narrative, which is a less fun answer, isn't it?
Yeah.
Because this obviously is an intermediate term low in my mind. When I look at this, there's zero part of me that would consider this low to be ever purged before we reach the buy side of the curve, right here. But it's not just because we come into this fair value gap. Why? What does this look like on a higher time frame? Look at a 4-hour chart.
Rebalance.
What are we rebalancing? We're rebalancing this order block, right? Plus, what have we done all week, Seek? What have we did all week?
Yeah, put in.
Induce.
Induce LRLR, right? When price does this, it's not coming anywhere near here until we reach the draw on liquidity. What is this showing you that the market wants to do after we've done this?
Go higher.
Explode higher, right? It's the last chance to do what? What is this called in here? This block.
Mitigation.
Mitigation, yes. It's the last chance for what to happen in this down close candle inside of this mitigation block. What's happening?
Buyer switching.
Yes, offset distribution of any offside positions. All right? It's the last chance for you to be like, fuck, I messed up, let me get out. That's what the market's literally doing. It's offering you one last chance to get out before it goes, right? Also, it's offering reaccumulation in what? What's the series of down close candles called?
Order block.
What is this called right here? Yeah, or the changes day of delivery, right? So what do we care most about if you've watched my order block lecture? The halfway point of these 3 candles. Without me drawing it, just coincidentally, where do you think this wick probably comes into? Hint, hint, nudge, nudge, wink, wink.
Mean threshold.
Yes, it's not random, right? That's not random. I didn't know that. How could I have known that? How could I have randomly known that? No, of course not. This is algorithmic. It does this time and time again, and it will continue to do this. This is how we know this is an intermediate term low. But it's not as pretty as me just saying, yeah, it balances half this FVG, right? That'd be easier for me to tell you.
Mm-hmm.
But that'd be me lying to you. It's not that simple. It never is. So the right answer, which is the answer you're going to hear me say a lot in the mentorship, is it depends. Narrative, right? Today, how much have we really talked about patterns, really? Maybe like 1/3 of this lecture has been on patterns. What's the other 2/3 been? Looking for SMT, looking for arrays of interest, looking at what the weekly profile is, right? Do you notice how none of that has anything to do with patterns?
Mm-hmm.
And yet that's what matters the most when you're trading, right? Because I'll tell you times where price will fail that same logic. Look, in here, do you see this wick? Why is this wick so fundamentally different to me than this wick? And for me, it is fundamentally different. I don't see these wicks as being equal. Like, SM, I don't see these as equal. Why do you think I don't see these wicks as equal?
Because there's no like higher time frame.
Yeah, the draw on liquidity is right here. Meaning,
Mhm.
there's not much upside after this wick, sure. We can come back in and retest where. In fact, where are we going to exactly retest inside of this wick? This wick right here. What is this wick going to come into exactly for this wick?
Consequence encroachment.
Yeah, halfway point, right?
E-
No surprise there. But for me, I'm not going to treat this as my long-term low in the market because I know we're going to reverse against it. And then what's this low going to act as? Sell stops. Whereas here, we have got to complete the market maker buy model, wherever it's going to the left. I got to look on a higher time frame before I even consider this is a draw on liquidity. But once the market reverses, guess where the market's coming for? That low. Only that low. Do you think this low matters to me now? What low has more narrative associated with it? You tell me. Which low?
The first one.
Yeah, this was where institutions were mitigated. Their offside positions,
Mhm.
mitigation. That's where sell stops reside. Same here. You think this low matters? No.
So
No.
This low
So
matters.
you're talking about when we come to the other side of the curve, targeting an
Intermediate term lows and
low.
highs. Yep, exactly. Yep, the
Oh,
best
as
the best
opposed to
targets are always
targeting-
intermediate term lows and highs. For example,
Mhm.
right here, you'll notice without looking, I can already tell you there's an SMT here. I know that based on how this candlestick reacted. So I'll put $5 on it maybe. Let's put $5 on there being an SMT here.
Let's fucking go, man. $5.
I'll give it to Todd if I'm wrong. Todd gets $5.
I just want to be a contrarian. That's all, man.
Double or nothing.
Yeah, definitely.
Okay, Todd gets the $5. Nope, Todd doesn't get the $5.
What? No, that's not where the line is. Come on now.
Oh my
Oh, he did it. Oh.
Come on.
Oh my gosh, Todd gets the $5.
Should have done double.
Damn it.
Hey, pal.
Damn it. Okay. Wait, what about this low? Wait, no, this is still valid, right? This is a down
Oh,
close
wait, you
candle.
have my paper.
This is a down close candle. There we go. What about this low? There we go. What about that? There you go. No, you don't get my $5. That's still a valid S&P. What is that? What type of candlestick divergence is this called? I just said it. Whoops. What kind of divergence is this called?
Candlestick divergence.
Candlestick
Candlestick.
divergence. So what on a lower time frame? This is gonna be what, Todd?
I'm sorry. What? My cat is fucking with me. What's
What type of divergence is this called in here? You don't get my $5 today. What is that called?
What? Divergence. The candlestick divergence.
Yeah, okay. I taught that 2 lectures ago, right? Candlestick divergence. So on a lower time frame, this is gonna be a swing low, correct?
Okay.
Right.
Yeah.
Okay, so there's that. You agree? You and I both agree. There's SMT right there.
Let's see.
Right
Well,
here.
You mean not where you drew it?
Right
but
there.
There. Oh yeah.
Okay, so you don't get my $5 today.
Yeah. Yeah, I agree. Yeah, no $5.
You get my $5 next time. Ah, damn, I'm getting
don't know.
ballsy with these. I'm lucky. I'm lucky this formed a down close candle there, or else I would have totally given Todd $5. But here's our SMT, right? There has to be an SMT here. Why? Because we're forming intermediate term low, right? Same exact logic. Intermediate term low, short term low. But now you guys are starting to see the reps, right? Here's the reps that we're putting in. So where's the best place to enter, guys?
To the right.
So again, $5 if what doesn't happen right here.
Right. Yeah, you probably have an SMT between those two.
All right, $5 again, Todd. You want to put it on it? You want to put up
No,
$5
man,
on this?
I'm on your side. I'm on your side. This time.
Todd's on my
Come
side this time, and it should be between these two candles.
On SMD or with a.
Oh, we're both wrong. We're both. You should have bet me. Oh no, right here. Never mind. We're both wrong again. SMT. Do you see it? There we
Also, there's not a. It looks like there's not a BISI created on YM. I don't know if you scroll up a little bit on YM.
No, there is. There is.
Oh.
No, there's a full-on SMT right here. It's just a lower time frame, just like a 30-minute chart or a 50-minute chart.
Yeah.
Where is it? Oh, I hate replay mode, dude. Oh no, I lost it.
March.
Right here.
Yeah.
See? We come below. There you go. SMT. We're convinced. We're convinced that this logic holds up all the time. There should be an SMT at this low. Cool. Enter on this low. Target. Where? Notice. What did we create? Remember we talked about this last time. What did we create during that move lower? What is this called? That thing that Afi said. Yeah. Trendline liquidity, low resistance liquidity. You notice? You
put it on the screen, man.
You notice how the market generates that? Go in and back. I mean, guys, half the battle is you backtesting this after. Because trust me, I've already learned it. That's why I'm teaching it to you. And half of the battle is backtesting. But look at how beautiful price will do this thing of putting in equal highs. Do you see the equal highs we're putting in here? You all see that, right? Like, visually, we're putting in these equal highs. And then we're coming back in, forming SMT. Where the hell do you think price is going once we do that?
Right.
To those equal highs. Into what? The PD area of interest. Guess what this is also going to be? What is this going to be of this range? From here down to here. Where do you think we're coming back into? Premium discount, right? All the concepts apply with each other. Let's do another example and then we're done. Then I really got to go.
It's almost like we wouldn't have like if you go back. Oh, anyway, you don't have to go back to that example, but just kind of like it's putting in. It's just like that last inducement.
Yeah. We're always the market
reaches the target. So if it reaches the target without putting in a short-term low, it's probably not the target.
Yep. Nice. I like that. Okay. So let's take a look right here at this nice, really, really nice short-term or intermediate-term high. Okay. Now that we've done the logic together, what forms here, guys, at this intermediate-term high? What do we know forms here? Most likely.
Let's see.
Are we happy? Are we convinced? Do we all see it?
Yes. Mm-hmm.
With the YM? Everyone sees it?
Mm-hmm.
Do you notice how I'm not doing anything different? We're approaching every single hindsight example the exact same. Why do you think we're doing it like this? Because in hindsight, if you can see it, you'll be able to see it in real time. Trust me. It's the same. Convince yourself that what I'm teaching you is true. Okay. So where is the highest probability entry? Someone, not Todd. Someone else answer. Where do we want to enter, guys?
The intermediate.
Go for it.
To the right of the intermediate.
Nice.
Hello?
So where is that?
High.
This high? No, what does this high lack that we care more about? Time, right? It's kind of at the end of the day. It's still a good trade. It's still a good trade in the PM session. But London forms a high of the day right there. With the context of this move, why do you think the protraction profile, right, for this day is a New York reversal? Because what does London do? It distributes to the draw and liquidity. What do you think forms right here then? We're going to do it on both sides of the market. What do you think forms right there, guys? SMT. Let's prove it to ourselves. Is there SMT? Yep, there it is. It's not with that low, it's with this low. There you go. SMT, reversal, higher time frame array. This is like a 4-hour order block. It doesn't matter. The SMT confirms that we're not going lower once we break structure higher. Now we can do the exact same exercise. So again, did we get a good entry here? Yes or no? What's the last thing we forgot to do? What do we think should occur here as well? So what am I expecting to see right here? Or right here?
SMT.
Notice how I'm predicting it now? I don't actually know. Somewhere on the other charts, I'm going to see something like this, guys.
Also, I think I'm sorry, man, I'm talking so much, but also because we don't have a market structure shift that we put it in with like a swing low on the left, on the buy side of the curve. So we have to put in a swing low that then we can create a market structure shift, right?
Yeah. Yeah. There you go. Do you guys see it? Right here with the YM? Do you see the SMT? Perfect. So now our criteria is met. Are we proving it to ourselves? Notice how we're doing it without looking because we're expecting it. SMT forms here. What does this become? Chitra, what is this now anticipated to be?
Long-term intermediate.
Yeah, intermediate term low, right? You can call it long-term low, you can call it intermediate term low. They're the same thing structurally. Doesn't matter. All the difference is a slight nuance. Short-term low to the left. Right, we're doing this on both sides of the curve to show that it works on both sides of the curve. Where's the best entry?
Right, short-term low.
Are you going to enter at 3 p.m.?
No,
Not even
I'm not there.
Are you going to enter in the Asian session?
No.
You might enter in the London session, but I'm seeing London not displace. I would just choose the next low, put it in New York. See how we're using context? Boom, right there. Right. Here. And again, look, this is an example of, what day is this today? Wednesday. What happens at Wednesday at 2 p.m.?
There's a sweep of.
There's
there's
FOMC, right?
Oh.
So then, this is our entry. This is our entry right here, actually. Right? When the news comes in and sweeps. What do we know forms right here? Todd?
I'm sorry, I was drawing something else up.
What do we know forms right here? Look, we're doing the buy side of the curve, dude, right? So let's get rid of this. This is our sell side of the curve. Now we're predicting how structure forms with context. Intermediate term low, short term low, SMT formed the intermediate term low. Here's our Wednesday FOMC folder. Here's our sweep. What do we know forms right here? SMT. Let's prove it to ourselves. This is the best place to enter on the chart, remember, right? We're not coming down here. So we're going to enter here, and we're going to wait to see the SMT form. Ready for it? Ready for it? Do we see the SMT, the massive SMT? Can everyone see it? I'm going to mark out the same lows on all three indices, okay? I'm just going to do them with horizontal lines. Oops. I want to drag this thing. I'm just going to draw a horizontal line at all three of the same lows so we can very easily see the SMT. Does everyone see the SMT at this low? That is where you position yourself. Say you miss it. What is like, remember we said this is the next best entry. What's the better entry after that? The next low that's formed. Unfortunately, are you offered another low, Todd? No. Not during this trading day, right?
Sorry.
We're not offered another low, right, on the hourly chart?
No.
Until the next day in Tokyo.
March.
But also, look, Tokyo offers another low. Where's the DOL? Actually, until the DOL is met, we're solid. Yeah, there you go. This is a high probability low. Now this is a high probability low. And now this in here. Is that something you'd want to long? Here, question. Would you want to long this low now?
What? No.
Why?
Well, I mean, just obviously because the draw on liquidity has been met.
Draw has been met. So now we have the formation of a sell side of the curve, and you can do the same
Probably
exercise.
Probably have SMT up there too.
Yeah, there is. There's most definitely an SMT right here. We can prove it to ourselves. And then what does that make this? Again, we're just repeating the same things, right? Long-term high, right? Here's the SMT, right? It's right there. Holy shit. ES exploded. This is a much higher time frame SMT if there is one.
No, I think you're at all-time highs there, no?
Oh, this is all-time highs. Never mind. So there is an SMT up here, is there?
No, but there's
All
probably,
three markets reach all-time highs. this
Okay.
week.
there's probably an SMT after that. No, yeah.
Yeah, there must be. Oh, it's right here, between the Dow and the Nasdaq. Okay, so there's your SMT in here. Now we have this high formed. Okay, so once this high is formed, it becomes a long-term high. Great. It's actually this high right here that forms the SMT. Long-term high. To the left and right we study, right? Okay, so where's the best entry?
To the right.
Not in the Tokyo session, but in the London session. Perfect, right? Now we're gonna see an SMT in.
Hafiz,
What's up?
Hafiz, I have a question. So on the earlier the New York session that you said was an ideal entry, it was at 3 p.m. Would you still kind of enter that?
Oh,
The one, yeah,
here?
this one.
Oh,
1 p.m.
Yeah,
okay.
and that's
I thought
because
it was
that's
3,
that's
sorry.
because the only reason I enter here is because what happens right here. What event do we have right here?
FOMC.
The devil's.
Yeah, FOMC, right? So we have nothing going on all week actually that's going to be meaningful until that event. And that event, unfortunately, liquidates most of the draw in one day. So you don't actually, if you don't catch this, you catch nothing for the week really of high probability. Unfortunately, which I don't think I got this week. I remember like last month in March, I didn't catch that candle, and I was like, well, shit, no trades for me today because we've reached the draw. But then we come in, and you'll notice, go in your charts, there'll be an SMT right here, right? Then we'll get a short trade. Then we'll reaccumulate. We'll chop, 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 chop. There'll be another SMT right here. Right? And then eventually when we get the large reversal, there'll be an SMT at this swing point here. And again, the best entry is going to be right here. Now, I wonder if there's an SMT there. That'd be interesting. Because that's like a huge divergence then.
Yeah, I'll take you to ER.
No, it's just there's not going to be SMT here. It's all in this massive sell-off. Okay, so that's market structure. It can be complex, hence the name advanced market structure. But I hope you guys realize this idea like swing points can be predicted, and understanding which swing points are the most important things when you're trading, right? So when you're trading, for example, on Friday, now you're not wondering, well, why didn't this low hold? Well, this low didn't hold because, as you can see, we have our lower, here's that one, here's this one. Actually, do we liquidate the draw on liquidity? We're in a bearish day, but this gave you a decent trade. Yeah, that's a decent trade. I wonder if there's an SMT up here. Let's see.
I think there was. On
Yeah,
Friday.
I'd expect so based on just market structure, based on our lesson today, but you never know. Yep, there it is. Okay, perfect. So there you go. Where's the best entry for this long? Low, intermediate term low formed, right? Is there SMT at that intermediate term low forming? Shit, sorry. Excuse my French. Yeah, there is. Right here at this low. So we have that SMT. So where's the high probability entry? It's going to be right here in New York at 10 a.m. Trade long. Then we get an SMT at the highs. Right here. And that's why this low fails. And then when this low fails, we put in another one. And we close the day out right there, and that again would be your best entry because we have another SMT like that between these lows. So you'll notice that that intermediate term low that is formed, the low to the right of that with SMT is the best entry. I wonder if there's SMT here to the right. I'm going to do a 15-minute chart because it's too much, not enough time has passed on the hourly. Let's see if we get an SMT right in here. We should. Yep, we do. Do you guys see that? Oh, that's beautiful. That's so beautiful. Do you guys see this right here? If you're a swing trader, like you hold over the weekends, beautiful entry right there. Everyone see that?
Yeah.
That's your entry, right? Because it's coming off of, what is this again? Intermediate term low, right? Short term low. So then this entry right here, SMT, you can long it there. Where's the target? Where's draw on liquidity? So watch this get hit tonight now. Let's go back. Let's just go back to the hourly chart. Now we'll know if the lesson has validity if we sweep out this high, or actually it's this high. Whoops. If we sweep out this high, which what are we doing right now? Creating equal highs, right? If we sweep out that high, then again, market structure, advanced market structure gave you the best entry, right? Okay, cool. Good lesson. Everyone a bit more clear with kind of swing points in the market.